Let's work brief exercise 19.3 from chapter 19 regarding pensions and post-retirement benefits. Let's take a look at the problem, set it up, and we'll solve for the question. Brief exercise 19.3. On January 1st, 2025, High Need Company had plan assets of $280,000 and a projected benefit obligation of the same amount. During 2025, service cost was $27,500. The settlement rate was 10%. Actual and expected return on plan assets were $25,000. Contributions were $20,000, and benefits paid were $17,500. So we're asked to prepare a pension worksheet for High Need for 2025. Let's set up our worksheet, and then we'll go back in and we'll identify the required information. All right, so we have the name of the company is High Need. Hennein company. And this is our pension worksheet for 2025. All right, our first, we'll divide this into two primary sections. The first one is going to track the amounts that are involved in the journal entry so that we conclude at our varying balances for the pension expense. What's total pension expense? What's the impact to cash? And then what's the impact to the pension asset or liability? And then we'll also track a record for the projected benefit obligation and the total plan assets. So let's set up our worksheet, and then we'll start compiling the amounts. So the first three columns will allow for general journal entries. The second two columns will have our memo record. And the three columns we need for the journal entries, first one is pension expense, and then we need cash, and then we need to consider the impact of the pension asset / liability. For the memo record, we'll need the projected benefit obligation and the plan assets. We'll do some formatting here real quick. Let's make the column a little wider. There we go. Okay. Now we're ready to schedule in our items. So we start with our beginning balance at January 1st, 2025. So our beginning balance. The pension expense is going to be zero. The amount of cash is not relevant. We're not given the pension asset or liability balance, so we'll skip that. But if we go across to the memo, we look back at the problem, and it does say that the plan assets were $280,000, as is the projected benefit obligation. So the projected benefit obligation is $280,000, and that's a credit amount. And the amount that is in the assets is also $280,000, and that's a debit. So essentially, they have the responsibility of the obligation, $280,000. The plan assets are $280,000. So their pension asset or liability would actually be zero right here. Okay, so we said at the beginning, and again, we don't know what cash is. Cash for the company could be any amount given the volume of transactions that go through. So we don't have that information. Let's move down now, and we'll work on our capturing the dollars or the transactions from the company. So let's read through here. Next thing, during 2025, service cost was $27,500. So service cost for the year, that is going to be an increase to the pension expense, and I'm going to denote that as a debit. And the offset of that would be against the projected benefit obligation. That's going to increase the benefit obligation, also 27,500. And that will be a credit. Then let's see, let's read through. The next thing we have is the settlement rate was 10%. Okay, so that's going to be our interest cost on the projected benefit obligation. And we'll take the projected benefit obligation, multiply it by the 10%. Now we get $28,000. And that's also a credit to the projected benefit obligation with an offsetting debit to the pension expense. Let's see, that's two of the four things we need to consider for pension expense. We also need to look at an offset for any returns or gains on our profits that we made on our investments in the pension plan. And then if there's any amortization of a prior service cost. Since we did not read anything about a prior service cost, we know that that will not be included in this calculation. So we do need to go and get the actual returns. All right, so if we look back at our problem, we see that actual and expected return on plan assets were $25,000. And that's going to reduce the amount of total pension expense. The offset of that is over here to the plan assets. We know that a return on plan assets is going to cause them to increase. So that would be a debit over here. Okay, next, let's see if we continue to read through there. We've got contributions were $20,000. So cash contributions. So we know that cash is going to go down as we make the deposit over to the plan assets. So it's a $20,000 credit to cash, and the plan assets would be the corresponding debit. So the last thing we see that benefits paid were $17,500. Benefits paid, so that's going to come exclusively out of the memo record, with the projected benefit obligation being a debit of $17,500, and the plan assets are going to decrease $17,500. So this is via the credit, and over here would be the debit. Now that let's do a subtotal here. So a subtotal at we're at 12/31/2025. And I want to see what's going on over here. So the balance of my projected benefit obligation started as a credit of $280,000. I add another credit of $27,500. I add another credit of $28,000 for the interest, minus the amount of benefits were paid, leaves me with $318,000. And then for the plan assets, started at a debit of $280,000 plus a debit of $25,000 plus an increase of $20,000 for contributions minus what was paid out, leaves me with $307,500. So the difference between those is our adjustment to the plan asset or liability. And we see that our obligation is $318,000. The amount of assets we now have in there, it does not equal the PBO. So there's a difference now. 318 versus 307,500. What is that difference? It's $10,500. Therefore, the journal entry required for our pension expense, I've got a debit to service cost, an increase. I've got an increase in the expense related to the interest cost, minus actual returns. So my pension expense is actually $30,500, and that's going to be a debit. And my cash only involved one journal entry or one amount, and that's a credit of $20,000. So we a credit. And then lastly, to balance, I'll have a credit to the pension liability. And these are actual dollar amounts that will go into journal entry. We'll set that journal entry up here momentarily. Okay, so one thing to note in the table in the worksheet, so we actually show the actual return on the worksheet. This way it ensures that the plan assets are properly reported. So we had the actual return versus the expected. We use the actual to make sure that they're properly reported. If these were to differ, then we need to make an additional adjustment to compute the proper amount of pension expense. But in our case, they were the same. 25,000 per the problem was the return for actual and expected. So therefore, we're good to go. Everything came off of the problem in the textbook except for the interest, which again was based on 10% of the projected benefit obligation, giving us the 10% settlement rate that was noted in the problem against the beginning balance of the projected benefit obligation of 280. Let's see, we'll take it one step further. The problem's not asking for it, but just so you can see what it looks like. The journal entry that would result for this year. So we complete the worksheet. The purpose of the worksheet is to verify that we've captured everything correctly, and it shows us the journal entry. So we'll debit pension expense for the $30,500, and then we will credit cash for $20,000 and a credit to the pension liability for the remaining $10,500. So there's the journal entry side, which we noted over here, the general journal entry side, and then the memo, so we can track where do we stand as far as our projected benefit obligation as it compares to our plan assets. At the beginning of the year, the PBO and the plan assets were the same, therefore there was no difference. However, at the end of the year, we are short a little bit, and that our obligation is $318,000. However, we only have $307,500 of assets, so we do have a pension liability of $10,500. So we captured that in our journal entry as well. So at this point, let's try to shrink this down where I can fit it all on one page for you. Okay, so at this point, it does conclude the explanation to solve brief exercise number 3 out of chapter 19.